Okay, let's go ahead and get started. Again, my name is Jason Maida with American Pacific Mortgage. I'm going to be your presenter this evening, and welcome to our Long Beach Homebuyer Workshop. We get a chance to teach these workshops basically every other week to various audiences across California. This is designed to really help you get on the path towards homeownership. So whether you're looking to purchase this year or it's like well, this year we don't really have a lot of time left, but for the upcoming year for 2023, this is one of your financial goals to be in home ownership. Hopefully this is a workshop that'll allow you to really help with achieving some of those objectives, but really get you on that path towards home ownership. As I mentioned earlier, this is a very interactive session, so we encourage you to just kind of chat with us. If you have questions, I'll answer those on air. There's a lot of things maybe that you're thinking, some of the other guests are probably thinking the same thing, so I really encourage those questions. All the material that we share with you this evening, we're going to go ahead and email back out to you tomorrow morning. So we really encourage you to take great notes because you'll help with the retention of some of these key concepts. But we also will send the presentation material to you as well. So you probably heard about this workshop because of our partnership with Long Beach State. So we're really proud to be a partner of Long Beach State, which we've been in partnership for just over a year, and really glad that we can get a chance to bring some of this information to the Southern California markets, as well as across all over California. Just a little bit about me. So I'm a branch manager with American Pacific Mortgage, and not only do I present some of this content every other week, I also get a chance to work one-on-one with clients in designing home buying plans for them in their path towards home ownership. So hopefully, as we leave today's session, if you do have a question around home ownership and you do want to get together and go through a consultation, we'll get a chance to put that roadmap together for you. Okay, so we already had a question that came in. The question is, can we go over FHA loans? We will definitely go over FHA loans. And so we're going to go over that as well as other products. In fact, that's a great segue into tonight's discussion point. So we're going to look a little bit at the housing market in just a bit. We're going to do a rent versus buy analysis, which is, kind of just figuring out, does buying make sense for me? So when you compare your rent versus your, kind of projected buy scenario, what does that look like? Talk a little bit about credit and how that can help kind of put you in the best possible position to purchase. We'll look at student loans and how those can impact qualifying. I know there's some legislation out there to help with forgiveness of some of the student loans, so we can talk through that a little bit as well. We'll look at loan programs, as we just got the question in about FHA loans. We'll certainly talk about FHA loans and how those can be used to help qualify you for a mortgage. Then we'll look at income and assets, some of the documentation you might need to purchase your home, as well as maybe savings goals for your home purchase. And speaking of savings goals, we're also going to talk about down payment assistance programs, which are usually some of the kind of the key components of some of these classes, just to learn a little bit more about some of the state assistance programs that are available to you. We're also going to share with you a new program that's set to launch in early Q1 of this upcoming year. And then finally, we'll wrap up tonight's discussion looking at the loan process. So what does it look like to be pre-approved for my home, to go through all the different milestones of the process, and then finish up with getting the keys to my house? So we'll kind of walk through that process, also look at what a consultation looks like, as well as a pre-approval. So hopefully all these talking points will really help kind of you on that path towards home ownership. And as we're getting ready to start that journey, we got to first of all kind of look at our budgets, right? We got to figure out, does buying make sense for me? Because home purchasing, especially in this market where prices can still be a bit high and interest rates are, obviously a lot higher than they have been the last couple of years, buying doesn't make sense for everyone. So it's really important to do some budget analysis, and we're going to help you with that this evening. But when you think about buying a house, it's an asset, right? So there's some really great things that come along with owning a home. You have the ability to create stability in your housing payment, so more of a controlled budget. You don't have to worry about a landlord increasing your rent over time. This is an asset, so you have the ability to be able to pass along that asset to the heirs of your estate. There's equity that can grow over time. So equity is created by the purchase price of your home and, of course, what you owe on the house. The difference in what you owe on a house versus what the market value says, that difference is called home equity. And, we've seen home equity levels at all-time highs just last year. Obviously, that's changed a little bit with the markets, but nonetheless, home equity is another form of asset for you in growing your financial wealth. And finally, there's some great tax benefits that come along with owning a home. So the potential tax deductibility of interest can be a huge feature for a lot of homeowners. Now, I want to kind of take us through a rent versus buying analysis. So what we're going to do is we're going to go through a calculator, and this calculator is through the Freddie Mac website. And what I'd like to walk us through is just, what does it look like if I was to continue renting versus what it could look like if I was going to purchase a home. So let's take a look at this calculator and kind of just run just a what if scenario so we can kind of see putting side by side what renting can look like versus what it could look like on the buying side. Okay, so let me just share with our browser here. Okay, so let's walk through a scenario, and I know every scenario is going to look a little bit different for everyone, but let's take a look at a scenario where we have, let's say, $2,500 a month in rent. We're going to assume monthly renter's insurance of $15 per month, and then we're going to add in 3% expected rental increase year over year. All right, so as you renew your lease, then that rent can potentially go up by 3%. Now, the other fields that we're going to add on or add into or put inputs into, we're going to put home price. So let's put our home price, depending on obviously where you're going to buy, the type of property, but we're going to put in $525 as our purchase price. The minimum down payment as a first-time buyer is 3%. And then for property taxes, generally what we're going to estimate taxes at is 1.25% of your sales price. We have estimated homeowners insurance of $1,000 a year. And then we're also going to plug in maintenance, which obviously if you purchase an older home, you might have a little more maintenance than say if I have a brand new construction home. I'm going to put in $1,500 for the maintenance cost there. And then we have loan information. So more often than not, as a first-time buyer, we're going to utilize a 30-year fixed mortgage. Then we're going to have an interest rate. In fact, I get the pleasure of actually putting a different rate in here. So probably 6.25 would probably be a realistic interest rate right now. We're going to talk about interest rates in just a minute because rates came down about 0.5% last week. Then there's origination charges. Those are what you're going to pay for lender costs. Typically, there's an origination fee that's under processing fees and underwriting fees. The great news is if you're part of our Long Beach State alumni, you get a discount in your processing fees. So normally it's $910. That gets dropped down to $160 because of the $750 discount with our partnership with Long Beach State. So really, really cool opportunity for you there. And then discount points, that is going to be an option you have as a consumer to basically try to buy down an interest rate. So if the rate is 6.25% today and you want to pay some additional costs, those costs can translate into a lower interest rate. It's called discount points. And usually a discount point of 1% will bring your interest rate down 0.25%. So let's say I finance $400,000 on my mortgage and I pay 1% discount point, that's $4,000. That $4,000 creates a lower interest rate of, let's say, from 6.25% to like 6%. And of course, when we do that or we make that choice, we want to do the analysis of kind of a break-even point. In fact, I did that with a client earlier today where we kind of looked at him taking a 5.5% interest rate, how much the cost of that was, and then how long is it going to take for him to break even on that investment. And those are things that we will do in designing a home buying plan for you. Now, the next section is other settlement charges. Those are going to be also part of the closing costs, and those can be for title and escrow fees, transfer charges for the county, recording fees. We're going to put that at about $6,000. But that will vary certainly based upon where you're going to buy and what's negotiated with the seller. The other assumptions we're going to make is appreciation rate. So the home, let's say it goes up 3% over the next 7 years, which is pretty reasonable. Selling costs of home, we always kind of plug in 10%. The reason why we do that is when you have a realtor that represents you as a buyer, those commissions that the realtor earns, those aren't paid for by you. They're actually paid for by the seller. But when I turn around and sell my house maybe 7 years from now, I'm going to have to pay those realtor fees to the agent that represents the buyer, as well as the realtor that's going to help sell my home for me. And then finally, we're going to put in state and federal taxes at 33.8 and then a savings rate of 1%. So what this comparison does is says, okay, if I'm going to continue to pay rent of $2,500 a month, I'm going to see my rent go up 3% every year once I renew my lease. Now, if I compare that to owning a home, yes, my mortgage payment is going to be $4,300 a month. It's going to be much higher. But when I look at my total cost analysis over the next 7 years, it actually saves me $33,000 over that 7 years if I was able to buy versus renting. And, obviously as interest rates change and, your home appreciates, those numbers can look a little bit different. But as we consult with clients throughout the day, most of our clients are having to purchase at a higher budget than what they're currently paying at rent, just given the cost of living. But nonetheless, when you look at that analysis over 7 years, it still makes sense to buy. Now, everybody's situation is a little bit different. If I'm renting a room for $500 a month and I'm going to run out and buy a $600,000 house, that math might not necessarily work very well for you. But at least this will at least show you what a side-by-side comparison could be in renting versus buying. So we had a question that came in. The question is it common for the seller to take on closing costs, or do you see it vary? So I would say it definitely varies. And we'll talk more about this later on, but closing costs traditionally are split 50-50 with the seller, but the market has switched up to more of a buyer's market. So I'm seeing a lot of buyers that are able to maybe get the seller to pay more of the closing costs. In fact, we had a client buying in San Jose this week, and they're getting a very large, what we call seller credit, that's going to help with them to be able to buy down their rate. So when we talk about discount points that we looked at earlier under loan information, so where a seller is giving a credit to help offset the costs that a buyer would pay to buy down their interest rate. So sellers are trying to get a little more creative, and they're certainly more flexible because, homes are not, flying off the market in 2 or 3 days. Now it's like 2 or 3 months. So we're seeing much more flexibility from a seller. Okay, great question. Okay, let's go ahead and jump back into our slideshow. And again, that was the rent versus buying calculator. Okay, let's kind of now take a look at what home appreciation is doing. And now it's obviously changing quite a bit, especially if those of you are joining us from, let's say, the Southern California markets. We're seeing all markets in California start to change quite a bit, especially over the last 3 to 4 months with the changes in interest rates. So as I just mentioned, you're not seeing homes fly off the shelves in 2 to 3 days. It's more like 2 to 3 months. So the marketing time is a little bit longer. As you can see in this slide, median days on market right now is 41 days on the market. And then you're starting to see inventory still down a little bit. Buyer demand has changed with the interest rate climate. As interest rates have risen, buyer demand has slowed down a little bit. Although what's interesting is for first-time buyers, we've seen really kind of about the same amount of demand out there on the first-time buyer side. And I think there's a huge opportunity for buyers to get in the market because now with prices starting to correct a bit, interest rates aren't ideal, but with prices starting to come down, sellers being a bit more flexible, I think it's an awesome opportunity for buyers to enter the market. When you think about purchasing a home, interest rates, while we know they are much higher, I think it's more important to get a lower priced home because interest rates, as home prices cycle, so they both cycle, but as interest rates go down, there is an opportunity for buyers to be able to refinance their home over time. So if rates eventually cycle down to 4 or 5% and you buy a house at 6.5%, there's an opportunity to be able to refinance, which is basically taking that existing balance and refinancing it to a lower rate to help bring down your overall monthly payment. Now, what we've seen in interest rates, and we're going to look more closely at this blue line because that's the 30-year fixed mortgage. That's going to represent really what 99% of our first-time buyers are going to be utilizing in terms of product. A 30-year fixed product, as you can see here, this is kind of the wild ride that we've been on with interest rates, right? So interest rates bottomed out in 2021 or 2020, I'm sorry, about 2.625 was the lowest rate that we saw. And then we kind of stayed in that position of the high twos, low threes for quite some time. And then as you can see, as we got into 2022, interest rates really started to elevate. In fact, just last month, we saw our highest level of interest rates topping the 7% mark. Now, in fact, we spoke on this last week. We kind of had a nice little surprise in interest rates last week. The consumer price index came out, and it actually came out lower than expected. It beat estimates by 0.3. What that did is the consumer price index came down, so inflation wasn't as high as they expected, and then interest rates followed suit with a 0.5% reduction. And so now we saw rates come down to that 6.5, 6.25 level, which is a tremendous improvement from what we've seen in the past, because we kind of were trying to figure out when our interest rates going to stop. Are we going to be in the 8% range? What is it going to look like? So certainly things are changing. We hope that trend continues with inflation getting a little under control, because as many of you have seen, the federal funds rate has been continuing to be increased to try to combat inflation. So if we can see some leveling in interest rates, that's certainly going to help out in the marketplace. I think I might have answered this first question that came in, but the question is, why do you believe interest rates have increased so dramatically this past year? Is it inflation? And yeah, I mean, it's part of the federal funds rate being increased by the Federal Reserve to control inflation. And as I mentioned, just if that consumer price index continues to start seeing inflation slow down, hopefully we'll start to kind of pull back on the amount of rate hikes. But the Fed hasn't made any announcement they are going to slow down our rate hikes. It's just what we've seen in the data as of last Thursday shows an improved inflationary environment. Now, it may not feel like that for us as consumers, but it's certainly starting to change a bit. But interest rates are going to be something we're going to have to really watch as we're kind of setting goals for home buying in 2023. Now, not all interest rates are created equal. And what I mean by that is there's different components that make up an interest rate. So, and how you get to an optimal interest rate. So it's based upon credit eligibility, the type of product you're going to elect, how much you're going to finance, what your down payment is. We talked a little bit about points earlier, discount points. Do I elect to have points to buy down my interest rate? What type of term of loan am I doing? Am I doing a 30-year fixed mortgage or am I doing a 15-year fixed mortgage? All those factors will attribute to what level of interest rate I'm able to achieve. Now, credit is one of the biggest components for eligibility to purchase a home, but as well as to optimize interest rates. And, as we meet with our clients for a consultation, we're going to definitely spend some time in credit. As part of our process, we actually start with a soft credit score when we do consultations with the client. And why we do that is because it doesn't impact the client's score because it's a soft inquiry. It doesn't come up as a hard inquiry. Now, the score calculation looks a little bit like this. So 15% of the score is how long I've had credit. 20% is going to be how much new credit I'm trying to acquire, so new accounts that are opened. But more importantly, like hard inquiries, just like I mentioned, there's a soft inquiry versus a hard inquiry. Soft inquiries don't impact that score calculation at all, but hard inquiries do. You have a 30-day window of time to have as many inquiries as you want with one particular industry, like the car industry or mortgage industry, as long as you do all those inquiries within a 30-day window. So let's say you do a hard inquiry today, that starts day one. Now you have 30 days to do your home shopping or your auto shopping for financing. Okay. So in use and new credit is 20%, 30% is going to be credit utilization. Credit utilization is going to look at your balances versus your credit limit. So if I have, let's say, $10,000 in credit limits or in credit limit, and I have a $5,000 balance, then I'm at 50% utilization. For most of our clients that are trying to optimize credit score, just improve credit score, that's probably the biggest opportunity is credit utilization. Now, let me give you a quick tip in how to manage credit utilization. So when we look at credit utilization and how balances are reported, credit card issuers will send out the data for your credit card at the end of your billing cycle. So if I have a billing cycle that ends on the 20th, but my due date is on the 5th, then let's say my balance is $5,000 on my $10,000 credit limit on the 20th, that $5,000 balance is what's going to be reported out to the bureaus. However, if I could pay off that balance or pay down that balance below or to whatever level, whatever that balance is on the 20th, that's what's going to report out to the bureaus. So many of our clients are paying off or paying down their balances on their due date, but that's not giving them the benefit of lower utilization because the credit card issuer is reporting out at the end of the billing cycle. Okay, so that's kind of just a quick tip on how you can better manage your utilization of credit. Now, the last component, which is pretty kind of self-explanatory, it's really payment history. It's 35% of the weighting. It's basically how you paid your bills. Payment history is rated as 30-day lates, 60-day lates, and 90-day lates. The more severe the late, obviously the more impact to the credit score. Now, every loan product, in fact, we're going to talk about loan products in just a second, has a minimum credit score. So FHA loans, it's a minimum of 580. A conventional loan is 620. Our VA loans are 620. And then the CalHFA first-time buyer assistance program is 640 for an FHA loan, 680 for a conventional loan. So there's other credit score factors that are going to be, kind of made up into the credit score. So if you've had past challenges like bankruptcy, short sales, collections, those are obviously going to be under payment history and impact the score more. I am going to show you a matrix of how long those things will stay on your credit report. Hopefully that'll be helpful for many of you. And then one thing to keep in mind is account closure. So when you close out an account, so let's say I've had an account for the last 10 years, I decide to do a balance transfer and then close out that account because I don't plan on using that credit card anymore. You just want to be kind of careful with that, because once you close out a credit card, not only are you closing it out so you don't have access to it, but the most important thing is when you close out that account, it takes all the great history out of the credit model. So the fact that that account's been around for 10 years and it was one of your lines of credit, it can impact your utilization, but it could also impact your length of credit. So you want to be careful before you close out accounts that you don't hurt your credit score. And finally, last thing I want to talk about on this slide is just around how lenders look at credit scores. So there's 3 different agencies. So there's Equifax, Experian, and TransUnion. So lenders will look at the middle score between all 3 bureaus. So here's what that looks like. So if I have a 740 score, 720, and 700, as a lender, I'm going to look at the 720 score for qualifying. Now, if I'm going to do a co-applicant or have a co-applicant, and let's say their score is 780, 760, and 720, their middle score is higher than mine. However, we're still going to use my 700 score because that's the middle score, the lowest middle score between both applicants. Okay. Okay, you got that one? Okay, perfect. Okay, so here's a matrix that'll show you kind of how past credit challenges will stay with you on your credit report. So those hard inquiries will be on there 2 years or less. Really, the things that appear in the last 6 months are going to be on the hard inquiries are going to be most impactful to your score. Late payments, collections, judgments, those are going to be all on your credit report for 7 years. If you've had a late payment in the last 12 to 24 months, that's going to hit your credit score the hardest. But as you get further and further away from that date of last payment, you should see that score start to grow or increase. Now, student loans is something that comes up quite a bit as we're meeting with our clients. I do realize that many of you are in forbearance if you have federal student loans, but even though they're in forbearance, we do have to count a minimum payment when it comes to qualifying for a mortgage. So now if you're on an income-based repayment amount, let's say it's $75,000 in balances. If you're on an income-based repayment amount of, let's say, $250 per month, that $250 amount is what we're going to use for qualifying purposes. And because you're in forbearance right now, we'll take that IBR or income-based repayment amount that you had prior to the pandemic. So if you're paying $250 a month prior to the start of the pandemic and the forbearance, that's what we're going to use for qualifying purposes. Now, if you just recently graduated and you haven't set up an IBR payment yet, you're just waiting for your payments to start up again, the default payment on an FHA loan is going to be 0.5% of your balance. So that would be like $375 on an FHA loan. And then the default payment on a conventional loan is 1%, or in this scenario, like $750. So those can impact qualifying. So that's one of those conversations we're going to have during your consultation. Now, if you're back in school, let's say you're working on your master's program, obviously your student loans aren't due regardless of they're private or public federal student loans. Even though you're back in school and you have kind of a freeze on those accounts, we still have to count a minimum payment against you for qualifying. Okay. So whether they're in, deferment or forbearance, there's still a minimum payment that we have to count against you for qualifying on student loans. Okay, so I know as we kind of launched in today's discussion, we had a question about, FHA loans, and we're going to go now into our loan program section. So we're going to kind of talk a little bit about different loan programs that are available to you as first-time buyers, even our second or third-time buyers. These are kind of the 5 core products that most buyers will be utilizing for their financing, and specifically conventional and FHA loan would be the most popular for first-time buyers. So let's talk a little bit about these products. So the conventional loan is a Fannie Mae, Freddie Mac loan. You may have heard those words before, or that terminology. Has a minimum down payment of 3%, up to a loan amount of $715,000. Okay, so that is called the conforming limit. Now, once you go beyond $715,000, that minimum down payment jumps from 3% to 5%, all the way up to a loan amount of $970,800. That minimum down payment varies by county. So if you're joining us from San Bernardino or Riverside County, it's going to look a little bit different in those counties. In fact, I think we have a slide to show you kind of the different loan levels by county. If not, we'll send you a kind of a link to that as well. So conventional loans, minimum down payment 3%. FHA loans is the minimum down payment is going to be 3.5%. And so FHA loans are not just for first-time buyers. You can be a second or third-time buyer and utilize that product. It goes all the way up to a loan amount of $970, $800 in the LA and Orange County markets. It's a little bit less as we move further east, like I said, to San Bernardino, Riverside County. San Diego's a little bit less too as well. FHA loans, as you learned earlier in our credit segment, has a minimum credit score of 580. We're going to do some comparisons about mortgage insurance in just a bit between the conventional loan and the FHA product. VA loans are going to be obviously for our veterans that have served that have the VA eligibility. What's great about that product is a zero down payment option, up to $1 million. In fact, you can even go beyond $1 million with the VA product. So there's actually no cap on that, but it has a zero down payment option. USDA loans are going to be for more of our rural areas. So some of our desert communities, if you're in the Central Valley in California, some of those areas will qualify under USDA. It's basically a zero down payment option. And so it's for lesser populated areas, has a no down payment option, usually follows very similar to FHA guidelines, does have a minimum credit score of 620. And then the next product on this slide is called a jumbo loan. And usually jumbo loans are going to be designed for our clients that are buying and financing higher than the Fannie Mae or FHA loan limits. And it usually requires 10 to 15% down payment. And so that would be generally for anything above, say, $970,000 in amount finance. Now, usually as a first-time buyer or even a second-time buyer, you're going to save for your down payment, plus you're going to save up for your closing costs. But with jumbo loans, it's a little bit different because not only do we have to save up those amount of assets for the down payment and closing costs, we also have a thing called reserves. In reserves are additional funds that I have available to me just to show I have more kind of financial stability, so to speak. Usually the reserve requirement is 12 months equivalent of my monthly payment. So let's say I have a $6,000 mortgage payment on a jumbo loan. I would need to have an additional $72,000 in assets if I had a jumbo loan. And that could take the shape of maybe a 401k, 403b, maybe a checking or savings account or a brokerage account. There's a whole variety of different ways to be able to show those assets. Okay, so now let's talk a little bit about PMI, and that's also known as private mortgage insurance. And we'd like to do like a little comparison of looking at a conventional loan versus an FHA loan. So conventional loans for our Fannie Mae, Freddie Mac type loans, when we look at mortgage insurance is going to be based upon your credit score, how much you put down, and then how much you finance. So those three characteristics or factors will influence the premium that you pay for a conventional loan. Now, there's different ways of paying mortgage insurance on a conventional loan. There's a monthly mortgage insurance. There's a split mortgage insurance, and that's where you pay some of it monthly. You pay some of it up front. There's a single premium, and that's where you pay all of it up front. And then there's another thing called lender paid mortgage insurance. And that's where a lender says, okay, instead of getting a 6.25% rate, if you would like to buy out your mortgage insurance, we could set you up with a 7% interest rate. And the difference between those two interest rates creates enough revenue, so to speak, to be able to buy out the mortgage insurance. It doesn't really happen that often, especially in a competitive market right now, or I shouldn't say competitive, but an higher interest rate market. More often than not, buyers are electing monthly MI. Why they do that is because monthly MI is not for the full 30 years of the mortgage. You have to have it for at least 2 years. And once you have 2 years and 20 to 22% equity in your home, you can apply to have the mortgage insurance canceled. Let me show you what an example looks like on a conventional PMI scenario. So let's say I financed $450,000 and I had a 740 credit score, put 3% down. My PMI is probably going to be about $183.75. Now, I know many of you that have done some searches on Redfin or Zillow, you probably came up with a much higher figure. And the reason why is those websites don't factor in these three components. They kind of more of a general PMI amount. So as you can see, I mean, PMI is pretty reasonable on a conventional loan. The more you put down, the higher credit scores, the lower your mortgage insurance can potentially be. Now, FHA loans are a bit different. So there's two components to mortgage insurance on FHA loans. There's a monthly mortgage insurance, which is 0.85% of your loan amount. And there's an upfront mortgage insurance, which is 1.75% of your loan amount. And that 1.75 increases your overall total amount of financed. With FHA mortgage insurance, when you only put the 3.5% down minimum down payment, it cannot be canceled like you can with conventional mortgage insurance. The only way to cancel mortgage insurance is if you refinance into a different product, like let's say a conventional loan. Now, when we take that same 450 loan amount and now we kind of overlay it with the FHA, it looks like this. So we finance now 450, but we have to add on this upfront mortgage insurance premium. So that 78.75 gets added on top of the 450. And then we also have that monthly mortgage insurance, which is $324.32 a month. So obviously it's 40% higher than what we see on the conventional loan. And so you may kind of step back and say, why would I take an FHA product over a conventional loan if the conventional loan clearly is a much more inexpensive product? And the reason why is because there's different guidelines for each loan program. Like, as you heard earlier, the FHA loan has a minimum score of 580, where a conventional loan is 620. FHA is going to be much more lenient when it comes to past challenges. If I was late on a credit card last month, it would be very difficult to qualify under conventional, where FHA would be okay with that. Or let's say I had a bankruptcy that was 2 years old. FHA would be okay with that. However, conventional would want to see 4 years. So all those different kind of attributes or aspects of guidelines will kind of have a client look at one option or the other. And that's our job to kind of tailor something that makes the most sense for you. So we had a question that came in. So somebody had a question. Did you say there's a conventional FHA loan? So yeah, there's not a conventional FHA loan. There's a CalHFA conventional loan, and we're going to talk about those a little bit later. But it is two separate products. So you have a conventional loan, and then you have FHA. And FHA stands for the Federal Housing Administration. Okay. All right. So that's a little bit more about PMI. Now let's talk about some of the documentation that is usually needed in qualifying for your home purchase. So if I'm a W-2 wage earner, it's pretty easy. I just need my last 2 years of W-2s, some recent pay stubs, generally last 30 days. And then we're going to do some type of verbal verification and a written verification as we move through the process. If we're self-employed, a little more, I wouldn't say difficult, but it's going to be more paper intensive. We're going to have the last 2 years of tax returns, probably a profit and loss and a balance sheet. We're going to need to verify the business either through a business license, maybe a CPA letter. The business will have to be active at least 2 years. So you have to have at least 2 years of filing to be able to qualify for a mortgage. Okay. Some scenarios that come up around income that I think would be super helpful for you. For our new grads, so some of our clients are just graduating. Let's say I'm graduating from Long Beach this semester, and I have a job all lined up at the beginning of the year. When you have a new prospective job, and let's say I just have at least an offer letter, we can still qualify you off of an offer letter for your mortgage. Now, one of the misconceptions out there is that I have to have 2 years on the job to be able to qualify for a mortgage. And the rule is actually that I have to have 2 years between my employment and or education. So, we can use, let's say I had 4 years of undergrad at Long Beach, and then I'm going out and getting a job in the accounting field where I got my degree in accounting. I would have that 2-year guideline met. And so, that's kind of a misconception we hear out there. We also hear that if he's transfer jobs, do I have to be at that other new job for 2 years? And that's actually not the case. So as long as we can show a 2-year work history and or education, once you have an executed offer letter from the new job, we can look to use that for qualifying right away. Now, it gets a little tricky for clients that have dual employment. We see this a lot in the healthcare industry. So let's say, I work for one clinic for 30 hours a week, another clinic for 20 hours a week. In order to use both sources, so dual income, I do have to show that I've been on both jobs for at least 2 years simultaneously. Okay, so that's where that can get a little bit tricky. That's where that 2-year requirement can really, be impactful. If you have a W-2 wage earner job, so you have a 40-hour work week job, but then you also, let's say, drive for Uber on the weekends. If you want to include that Uber income, because it is contract employment that you're filing a Schedule C on, you just have to show that you're doing both the W-2 employment and the contract employment simultaneously for 2 years. Okay. All right, so as we kind of look at income as a lender, we're going to look at your monthly income versus your expenses. For W-2 wage earners, we take into consideration the gross monthly income versus expenses. For self-employed individuals, we're usually looking at the net income of the business versus expenses. At the end of the day, this calculation that we utilize is called the debt to income ratio, and it looks at that income versus expenses, including the new mortgage. Usually we don't want your expenses, including the new mortgage, principal and interest, taxes, insurance, mortgage insurance, kind of everything. We don't want to exceed 45% of your monthly income. Now, that's not necessarily an indication of affordability. I think an affordability is going to be more around when we look at your overall budget and what you're paying in rent today versus what it could look like as homeownership, what's going to be an affordable number. Debt to income ratio is just simply looking at qualifying for you. So we're talking about qualifying income and qualifying obligations. So here's what a debt to income ratio looks like. It's the principal and the interest for the mortgage, the property taxes that you're going to pay on your house, the homeowner's insurance. And then if you've put less than 20% down, we have that thing called PMI that we reviewed earlier. And let's say I was buying a condo, for example, then I would probably have an HOA, or what we call as homeowners association dues. If the sum of all those items was $2,500 a month, and then let's say I have $500 in other expenses, and then I'm making $8,500 a month. If I was to take those $3,000 in expenses versus my $8,500 in income, my debt to income ratio is about 35.29%. And that would be well within the qualifying. In this kind of higher cost of living market, we are seeing higher debt to income ratios. That's just kind of the reality of California living. But we can go up to the 45% debt to income ratio. In some cases, you can even go up to 49%. But the most important thing is to really understand your affordability and what's an affordable budget for you for home buying. And that's what we will help you with during your one-on-one consultation. As I meet with first-time home buyers and they ask me about debt to income ratio and kind of what's a good place to be, usually I find that most clients are feeling good around a 33 to 36% debt to income ratio. Now, there may be other income in the household that we can't just document, so that may change things a little bit, but all in all, 33 to 36% is the number. Okay, the last aspect of home buying. So far we've talked a little bit about credit, income. We talked about a little about product and how those different characteristics of products can help you. The last component of home buying is going to be down payment or assets. And documentation of assets can come in various forms. So obviously checking and savings accounts, what you have saved in those accounts can be used towards your home purchase. Cash deposits cannot be used. And we do have to paper trail all transactions in that account in the last 60 days. So if you had a $10,000 deposit that came in, and we just got to figure out where it came from. If it was a gift from a family member, we have to trail that gift and make sure it came from a viable source. Gift funds are allowed, as you can see on this slide, but there is a process for paper trailing that. The donor has to complete a gift letter. We have to show the transfer of the funds. And in some cases, we'll need to see where that money originated from. Other accounts like 401ks, 403bs, IRAs, those can all be potentially used, but we really encourage you to talk to your tax advisor, maybe your financial planner, before accessing those accounts, because those could impact you from a tax perspective. And of course, in today's market where we've seen the stock market dip quite a bit, we don't necessarily want to tap into some of those assets that already might be at lower levels right now. And then, as I mentioned, gift funds are something that, family members or ultimately family members helping you with your down payment and or closing costs. Usually we're going to need at least a gift letter from the family member completed, as well as, proof of the funds, and then some type of documentation of the receipt of those funds. Now, assets as well as credit can probably be two of the biggest challenges for first-time home buyers. And credit is something that, we can help improve with over time. And then, of course, savings can grow and improve your asset situation. But, for a lot of our buyers, assets and just having liquidity for down payment tends to be one of the biggest challenges. And so we partner with CalHFA, which is the California Housing Finance Agency, designed to help low to moderate income households achieve the dream of home ownership. And what we're going to do now is kind of go into the section of our workshop where we kind of dive into some of those first-time buyer programs and talk a little bit about different resources that can help you make buying that much more of a near-term goal. So rather than having to wait to save 3 or 4 years down the road, maybe this is something that can bring homeownership as more of a near-term goal for you. So the three kind of key products we're going to talk about tonight, more so these first two, because this third one is kind of under construction right now, but I'll kind of give you a little bit of a high-level look at it. The first one is the Equity Builder program that provides up to 10% of your sales price in assistance. As long as you stay in the property for 5 years, it's completely forgiven. It is designed to help our low-income housing consumers, and I'll kind of give you an idea what those income limits look like in just a bit. The next product is called the My Home Assistance product. On a conventional loan, it provides 3% of your sales price in assistance. On an FHA loan, it's 3.5%. So as you can see, it kind of meets those minimum down payment requirements for both of those loans or both of those loan products. It's not forgivable though. So when you either sell the home or if you refinance, you do have to pay that assistance back. It's going to be designed for more of our moderate income households. And then the next product that again is kind of under construction right now, it's set to launch, we're hoping, early Q1 of 2023. And this is a really kind of unique and kind of forward-thinking product for CalHFA. It's going to have a new component that hasn't been used at all, but it ultimately is going to provide up to 20% in assistance. It's not forgivable, but it's not repaid back to the state until you either sell the home or if you refinance in the future. Now, there's another component. This is kind of the uniqueness of it. It does have an equity share agreement. And the equity share agreement states that, let's say my house goes up $100,000 in value over the next 7 years. The state would participate in that equity share up to 20%. So if it grew by 100,000 and then you sold the house in 7 years, 20% of that equity or $20,000 would be shared back with the state at the sale of the home. Now, the trade-off is we get 20% in assistance and give up a portion of our equity, but the opportunity to put 20% down instead of 3% down is a massive difference. As I've been meeting with clients and kind of sharing at a high level this product option, it changes the payment maybe $900 to $1,000 in some cases. So it's a pretty big deal, and it may be something that could work for you in your homeownership journey. It does also follow the moderate income limits, and so this is what the income limits look like for the program. So for the Equity Builder program, LA and Orange County, it's $78,320, and you can see Riverside and San Bernardino. So those are more low-income housing. And on the other side of it is the moderate income, which is 180, 235, 173 for Riverside. These income limits are updated every June. So June of 2023, we'll see another iteration of income limits, but this is what they look like currently. For those of you that are joining us that may be in the Bay Area markets, these income limits are higher across the board. For most Bay Area equity builder eligible zones, it's 120,000 for most Bay Area counties, except for Santa Clara County's 133. And then for the moderate income goes up to like 300,000. Okay, let me give you a few more details about the Equity Builder program. So it allows you to borrow up to 10% of your purchase price or appraised value, whichever is less, and the funds are forgiven after 5 years. Okay, now those income limits that you just saw, they're based upon 80% of the area median income. It allows you to get the 10% assistance, and you can add up to an additional 20% on top of that. So for a total down payment of 30%. Now, it just can't be combined with the other programs that CalHFA offers. So it's kind of like a standalone product. Now, an update that's really important on this program is almost out of funding. So there's about $11 million left in funding for the product. So from what I understand, there's about 2 to 3 weeks left of funding. So I know we're talking about it in this workshop, but the reality is there probably won't be a lot of funding left for the Equity Builder program. The goal is to kind of transition our clients from Equity Builder eligibility into the California Dream product when that launches at the first of the year, or hopefully in the first of the year. Let's look at an example of kind of just looking at just a traditional conventional loan and then kind of overlaying the Equity Builder program just so you can get a sense of how this helps home buyers. So let's say I bought a $500,000 house and my minimum down payment is 3% or $15,000, as we know, right? And then we have closing costs, and closing costs can range anywhere between 2 to 3% of our purchase price. So on a traditional sale, I'll probably need $15,000 plus another 10 to 15,000 for closing costs. So probably 25 to 30,000. Now, if I had the Equity Builder product, I can still buy the same $500,000 house, but now I have $50,000 in assistance to work with, and I can allocate that $50,000 how I want. Let's say I want to put 7% down, then use the rest of the money for closing costs, or maybe 10% down and then pay for my closing costs out of my pocket. There's a variety of different ways on how we can structure that, but at the end of the day, a buyer's able to get up to $50,000 in assistance. Again, That's a product that's going to have limited resources for it, but I do want to share that with you in case some of us that are joining tonight's call are actively looking at homes. It's still not too late to get qualified for that. It's just something that we would have to identify a property pretty quick. Now let's talk a little bit about the moderate income products. There's the My Home Assistance Program. As I mentioned, 3 to 3.5% of your sales price, depending on your product. It is a low interest loan at 1%. And then the way that works is it's simple interest. You're not required to pay back the assistance until you either sell the home or if you refinance in the future. So it's total deferred payment. Now, there's another product listed here, which is called the Zero Interest Program. That program has recently kind of come back up to 2% of our sales price in assistance. And what that can be used for is for closing costs. It's a zero interest loan. You can add 2% of your loan amount. So let's say I'm financing $400,000. I can get an additional $8,000 in assistance that can be used towards my closing costs. No interest loan. It's not forgivable, but you would not have to pay that money back to the state until you sell or if you refinance in the future. Okay, now let's look at that same $500,000 home purchase example. Now I want to all these numbers are the same up at the top here, but now let's look at the My Home Assistance Program and how that could help. So $500,000 purchase, the same thing. That 3% down payment would be covered through the My Home Assistance. And then with the closing cost component, the ZIP assistance could add some additional support there. Because the ZIP assistance right now has limited availability, more often than not, clients are just utilizing the 3% assistance to cover their down payment and then having the remaining closing costs out of pocket. So there's some eligibility requirements for the first-time buyer program. Minimum credit score of 640 for an FHA loan, 680 for a conventional loan. If you qualify under the low-income housing products like the Equity Builder program, the minimum credit score for the conventional loan drops to a 660. There is a debt-to-income ratio maximum of 45%. In some cases, we can go to 50% for these programs. And the income qualifications are not based upon household size. They're actually based upon the applicant. And why that's important is because let's say I have dual income in my household. I make $150,000, my spouse makes $100,000, combined we make $250. But if I'm just applying just in my name, the $150 is the only income that gets counted against the income limits. And that's, something that's really important because most programs will count the entire income that's in the household. Now, a first-time buyer is not someone that's never, ever owned. It's actually someone that hasn't owned in the last 3 years. So let's say you sold your house in 2015 and you've been renting ever since then. Now, well, you're still considered a first-time buyer. And so you would be eligible potentially for some of these programs. And these programs allow us to lend on single-family homes. They could be new construction, condos, townhouses, manufactured homes, if it is on land that is owned. Even some of our what we call BMR properties, which are below market properties, they're discounted for low income housing. Those can all be potentially eligible for CalHFA assistance. Okay, any questions on the assistance program before we kind of go into the process? Okay. So question came in. Is there an income immigration eligibility for down payment assistance? Is DACA recipient eligible? So DACA recipients are eligible for the CalHFA assistance. All right, thank you for that question. All right, let's talk a little bit about the process of buying a house. This is our 6 steps of home buying. And I'm going to walk you through each one of these milestones and kind of give you a little bit more information around each of these kind of milestones that you'll go through. The 6 steps of home buying is kind of our journey of home ownership. And it starts as kind of a post consultation. So after you complete the consultation with us, we'll issue the pre-approval, and the pre-approval kind of signifies this is what you're eligible for. And it's a certificate that's provided to the seller to show your eligibility for financing. Usually that pre-approval certificate is good for 60 days, but it can always be easily recertified at any time. So if it takes you a little bit longer to find a home, some of our clients take 3 to 4, maybe a couple of years to find a house. We just need to update some information for you. And at that time, we can do the recertification. So pretty easy. So if you apply now and it takes you a little bit longer, that's not a big deal. We can always recertify at any time. So the pre-approval is kind of the start of saying, okay, this is what I'm qualified for. This is what my budget looks like. And now my next step is going to be house hunting. And usually you're going to start your house hunting with an online search. You're going to be looking at certain areas that you like. You maybe find a few homes that you kind of bookmark. And you probably will have a connection with a realtor, or hopefully you do, because as you learned earlier, realtors are paid for by the seller. We do have a fantastic network of preferred realtors. So after your consultation, if you want us to introduce you to one of those preferred realtors, more than happy to do that. But you'll start the home search in step 2. That's probably going to take the longest. That's probably the longest milestone, if you will, in the 6 steps. As you're out looking at homes, and let's say you decide to make an offer on a house, if you want us to amend your pre-approval to match your offer price, we can totally do that. In fact, I was talking to a client before tonight's workshop, and they got pre-approved for $600,000. But they think they really want to make an offer on a $530,000 house. So in some cases, their realtor will want us to adjust that pre-approval down to match whatever the price is they're going to offer on that house. Okay, so if we were to fast forward a bit, let's say your offer gets accepted, well, then we're going to move to step 3, and that's called entering escrow. So that means a seller has accepted your offer, and now you're in the escrow time period. And usually the escrow time period is anywhere from 21 to 30 days. So from my acceptance of offer to when I get the keys to my house, it's going to take anywhere between 20 to 30 days. With the timing in the market right now, I think it's probably more towards the 25 to 30 day mark. But step 3 means that the seller has accepted your offer. We're going to reach out to you within 24 hours of that acceptance to congratulate you, let you know a little bit about where interest rates are at, and then we're going to go ahead and schedule you for a follow-up consultation. And that's where we get a chance to get back connected with you to go over all your closing costs, your interest rate options, what assistance programs you may want to take advantage of. We're also going to order the appraisal of your house. We're going to talk more about that in just a second. And your realtor will order inspections on your house more often than not, unless the seller has existing inspections to share with you. Within 48 to 72 hours of your follow-up consultation, you're going to get initial disclosures, and those are going to highlight your interest rate, your payment, your total out-of-pocket expense. So you have clear and concise and really transparency of really what your financing looks like. Now, once you have an accepted offer, you are responsible to make what we call an earnest money deposit, and that usually occurs within the 2 to 3 days of the escrow time period. The earnest money deposit is usually 1 to 2% of your sales price. Now, that money goes directly towards your cash to close, which is basically your down payment and closing cost requirement. So it does count towards that. But that money is held in escrow while you go through what we call the contingency periods. And the contingency basically states that you're offering this particular price for this home, but it's contingent upon you getting a house appraised and ensuring the house is worth what you're paying for it, getting the house inspected, getting your loan approved. And all of those kind of components of the contingency usually will happen in the first 14 to 17 days of your contract period. And why those contingencies are super important is because they protect your earnest money deposit. So if there's an issue, and let's say you just don't feel good about what the inspections turned up, it allows you the ability to be able to cancel the transaction and get a full refund of your deposit. Now, 3-4 months ago, especially in some of our hyper competitive markets, it was really tough to get contingencies in place on contracts. But now with the market switching up so much, being more of a buyer's market, we're seeing sellers that are much more negotiable to contingencies. And I think it's really a great idea, especially for first-time buyers, to have that kind of added protection that you're not going to have a situation with a property that just doesn't fit for what you have in mind and then put your deposit at risk. Okay, step 4 after our follow-up consultation and you receiving your disclosures is to move into the processing phase. And that's where our team gets a chance to verify your employment, your assets, that we may request some additional documentation, but we're trying to prepare everything to go into the underwriting phase of the process. By that time, your interest rate is probably locked in. You've received your disclosures, like I mentioned earlier, and then we'll submit everything to our underwriting team. And that brings us to step 5. That's when your loan is actually approved by an underwriter. And at that time, you're about 3/4 of the way through the escrow time period. And you're probably at the end of your contingencies. So as long as your inspections have checked out, the appraisal comes back with a satisfactory value, and your loan has been approved, then you'll be able to remove those contingencies. It's important to note as a buyer, though, once you remove contingencies, it does expose your deposit. So if you decided to cancel after you've removed contingencies, then you could risk losing your deposit. So you just want to be careful that's the right decision for you. And certainly you want to consult with your realtor on that. At that time, we're going to issue to you a final closing disclosure. And that gives you a 3-day cooling off period before we get to the final stage. Because that 3-day cooling off period just allows you to kind of step back for a second, and make sure this is, kind of the right setup of your financing. There shouldn't be any surprises when you get that closing disclosure, because you've seen different iterations of disclosures that have gone to you. Now, after the 3-day cooling off period has elapsed, then we're going to move into the closing phase, and that's called step 6. And that's where you get a chance to, sign final loan documents. Those are done with a public notary, and they're always done in person. Everything up to that point is all done via e-signature. That signing process will take just about an hour or so, depending on, what questions you have and what products you're electing. After that's been completed, then you're going to wire in the funds that are owed in your cash to close. That money will be reconciled by the escrow team. And then after those documents have been all signed, we're going to go ahead and wire in the funds for your first mortgage. If you've elected any assistance programs, we'll wire in that as well. The escrow team also reconciles those funds. Make sure that you're contributing what you're supposed to as a buyer. The seller's receiving the proceeds that they expect. And after that is all balanced, they release documents to record with the county recorder's office. And they record a grant deed, which transfers ownership to you from the seller to the buyer. They also record a deed of trust, and that's your agreement that gets recorded with the county that says you're going to repay the loan that you're receiving. And after the escrow team gets the confirmation of those recorded items, then you become the official owner. Then that's actually when it's real, and you get a chance to, high five your realtor, go over to the house, get your keys, and celebrate this huge accomplishment, because it is a big deal. This is probably going to be one of the biggest investments you make in your lifetime. So, I know many of you taking out all this time in your Wednesday night to learn about this, but it's an important part of that journey towards homeownership, is really understanding what this looks like, because it is going to be, like I said, the biggest investment probably that you're going to make in your financial futures. Now, if you want to get connected with us for a consultation, you've heard me mention that a few times. We have all the links here on this slide that shows you the online application that you can complete. Again, we only start with a soft credit score, so you don't have to worry about having your score impacted, and you'll upload some documents that are prompted through the application, and then you'll schedule a video or phone consultation with us, and that's where we'll kind of go through your home buying plan. Now, if you have some just follow-up questions after today that you maybe just want to kind of maybe go through a credit scenario, or maybe just understand a little bit more about down payment or products, really encourage you to do an introductory phone call with us. That's just a 10 to 15 minute, just quick session over the phone. Of course, we always encourage you just to reach out for any questions, but if you'd like to schedule some kind of more time block with us, we'd love to be able to get connected with you on that. This is what a consultation looks like. So it's going to be going over very similar items that we talked about in tonight's workshop, which is, looking at your affordability, looking at where do we want to purchase, what kind of price we're looking at, interest rate options, closing costs, debt to income ratio analysis, credit. And we were just really kind of create this comprehensive review for you, so you really understand what your product options look like for you. Now, this is a fantastic tool that I really encourage you to download. This is our APM mobile app. You can actually start your application process right through mobile. You can do calculations on different payment scenarios, and you can also follow the progress of your loan right through your application. So really cool tool. And I know many of you are joining tonight's workshop because of our Long Beach State partnership, which we're really excited to be a part of. But we also have other partnerships across the country. And so if you're joining us through one of those, we're glad you got a chance to get connected with us. But these workshops are things that we do for all of our partnerships in our local communities to help educate our community on home ownership. So as part of our partnerships, we do pass along a $750 discount on closing costs. And all these workshops that we provide are obviously, they're free resources for you, as well as our consultations. There's no charge for doing a consultation with us. These are some of our remaining classes we have for the year. So if you really enjoy kind of what you heard this evening, encourage you to share the information with friends, family, maybe even some of your coworkers. So we have a couple more left, actually 4 left for December. So Sacramento, Los Angeles. If you have friends or family in Virginia, and then of course one for Irvine. And all of our whole class schedule for the remaining part of this year, as well as the next year's classes, can all be found at mortgageeducate.com. Here's all of our contact information. So if you want to reach out to me with any questions after tonight's session, please feel free to send me a message, give me a call. Email is fine too. And we love what our clients are saying about us. We really encourage you to check out some of our reviews on Google and Yelp. And a lot of the information that we share in these sessions, we also share on our social channels. So I'd really encourage you to follow us on Instagram, J Made a Mortgage. A lot of these updates, especially the funding for the Equity Builder program, as well as latest updates on the California Dream for All launch, we're going to be posting them all on our social channels. So, check us out on Instagram, and we'll be also posting other things that are super helpful for you on your home buying journey. So with that said, that kind of brings us to the end of tonight's workshop. I'm going to go ahead and leave it open for a little Q&A now, and see if there's any questions that we want us to cover here before we wrap up for the night. Okay, so we had a question that came in, and the question is, do I have to pay at least 20% down to avoid paying PMI? So yeah, I mean, the minimum down payment would be 20% to avoid paying for PMI, unless you decide to buy out the PMI. So that's an option too, where you can pay the single premium to buy out PMI. All right, and I think we just responded to the other question. So yeah, all the tonight's session will be we have a recorded version that'll be available to you as well. And in case you didn't hear me earlier, all of our presentation material this evening will be shared with you via email tomorrow morning. Okay. Well, thank you so much for joining our Long Beach workshop. Hopefully we get a chance to get connected with you soon. Have a